Hello, I'm David Mandy, president of O&M Partners. I want to welcome everyone today to the Seabridge Gold Town Hall webinar. For those who are new to these broadcasts, about 7 years ago, O&M recognized the sea change in the non-deal investor market. Most public companies gear their messaging to professional investors. This informed and empowered group is still present on O&M's calls, but we're also providing a high level of service geared to retail. Suddenly, public information is more available to a whole new generation of investors that can't be found in key financial centers. Investors are receiving information at home that used to be geared and available to professional investors in conference rooms. Um, so we welcome you again to the Seabridge call. Seabridge trades under the symbol SA on the New York Stock Exchange. The questions and Q&A are for everyone. Questions will be easily answered by going to the question portal of GoToWebinar or by emailing us. For any questions that remain unanswered, we'll follow up in a timely manner. For those who dialed in with your phone, please stay tuned. Our introductory speaker today will be Jim Anthony. Jim is a private investor who trades his own accounts. He's the co-founder of Seabridge Gold. He helped to finance and advise a number of junior gold producers and exploration companies over his career that spans the last 30 years. Mr. Anthony writes gold market commentary for Seabridge Gold's financial reports and is regularly consulted on the gold market by institutional investors in North America and Europe. Originally a student of economics, he's become a disciple of the markets. As he says, the tape can tell you much more than any economic model. It's a real pleasure to turn the call over to Jim.
Thank you, David. Many of you may be wondering why gold price is in the doldrums again. By the way, I was a buyer of gold stocks today, and not just to show confidence. I think we're very close to a bottom, but the problem is a narrative, as it often is with gold. Vaccines and a reopening of the economy are risk on. Real growth this year will range up to 8%, according to most of the predictions out there, 6 to 8%. There will be some temporary inflation from base effects, but nothing serious. The surge in yields is primarily due to growth, not inflation. It's peaked and it will subside. So with all that good news, who needs gold? And much of this is based on the Fed's latest fairy tale forecasts. They're really good at these things. It's too bad that none of them ever work out. The Fed has upgraded its real growth forecast earlier this month to 6.5% for this year. And no upgrade, by the way, to 2022 and 2023. 2021 inflation, 2.4%, but don't worry, it's transitory. Inflation will fall in 2022. The Fed does not, it says, fully achieve its 2% inflation target until 2024, and it will exceed it until maximum employment is achieved. But at the same time, the Fed is committed to anchoring inflation expectations at 2%. Figure that one out. No actions are needed to curb rising yields, so everything is just hunky-dory. QE of 120 billion per month, which is no small matter. It's actually more than QE3, and that will continue. Increases in the Fed funds rate won't happen until maximum employment and inflation targets are actually met. And that's projected to be 2024. So it's free money until then, at least. Now, there's some problems with this. And one of them is that inflation expectations have already pushed beyond the 2% benchmark. And in fact, the market, the bond market, especially credit markets, think otherwise. Not the stock market yet, but we think that's coming. The Fed wants inflation, but not the inevitable effects of inflation. That's magical. The Fed says inflation rates can be managed with pinpoint control when that's never been done historically. They can't be easily controlled when they arise. Anchoring inflation expectations at 2%, as I said, has already been lost. You can see the chart on the 5-year break-even inflation rate over on the right. And inflation, therefore, I would say, is the Achilles heel of Fed policy. They're all in with respect to inflation, and when they are proved to be wrong, which we think is not more than a quarter or 4 months away as we get more data, the Fed will dump its forecasts within that period and implement yield curve control. So they'll sit on the long end of the yield curve and keep it down, and gold will soar to at least $2,300 an ounce and possibly higher. There are four, so next slide, there are four drivers of inflation in our view. One of them, the classic one, demand pull inflation. That's where we pay lots of people to stay home because we want to increase demand in the economy. But of course, at the same time, we're not increasing goods and services. Ray Dalio has a name for this. He calls it monetary policy 3. I'll just quote from him a bit. When interest rate policy doesn't work anymore because you're at zero and growth has slowed down because of the debt load, monetary authorities always print money by monetizing debt to help those who need it, and that brings inflation. And this has been the history all the way back to the Roman Empire. There's nothing new here, and nothing like this works. So if you look at the slides we have here, the charts, the first one from Jeff Gundlach, you probably recognize some of these, shows that personal income of Americans, the percentage of that from government transfer and assistance payments has been as high as 31.5% in the very recent months, and is now floating around 27%. It's absolutely staggering, and it's going to go up again as the new stimulus package passed by Biden plays out. The next slide over tells you why this is necessary and why Ray Dalio concedes of monetary policy 3. This is a measure of real growth in GDP minus the increase in the federal deficit. In fact, US economy, apart from the US deficit, has not grown in real terms since 2007. That's why, for the vast majority of Americans out there, it doesn't feel very good. Real growth is absent. Therefore, all the stimulus that continues to be required long after the Great Recession and now into the current COVID experience problems. And so go to the right, it takes about $12 in support of various kinds from the Fed and the Treasury to generate $1 of economic growth. So here's an interesting quote just to support all this from our Federal Reserve Bank of St. Louis. Quote, a solution some countries with high levels of unsustainable debt have tried is printing money. In this scenario, the government borrows money by issuing bonds and then orders the central bank to buy those bonds by creating, that is, printing money. History has taught us, however, that this type of policy leads to extremely high rates of inflation, bracket, hyperinflation, bracket, and often ends in economic ruin. That's from 2 years ago from our own Federal Reserve Bank. Thanks for explaining where we're headed. Next slide. The second driver of inflation is cost push. Some people think you can't get inflation without cost push, but we're getting it now. Peter Bookvar, a very well-known economist, has figured out that if you take the jump in average hours worked plus the increase in hourly earnings, you actually can figure out that year over year, labor rates are up 7.5%, because from the business point of view, that's what they're paying. This is, of course, a lot more than just following average hourly earnings would tell you. Weekly earnings are up substantially thanks to overtime. And it stands to reason that this would be the case because, as Peter says, why would anyone go to work today at pre-COVID pay levels? They've been paid to stay home. Some paid rather well. And there's a sniff of inflation in the air. You can see that in the public opinion polls now. 77% of Americans think inflation is going to rise. So you hold out for more money. That in itself is inflationary. So next slide. The fourth driver of inflation. This is from Jim Grant. It's kind of my favorite, but I'm a fan of Jim Grant, interest rate observer editor. His comment is that it's the fiscal situation of a nation that really triggers inflation in the end, and it did in Germany between the wars. I'll read you his quote. What history shows is that inflation is often a collective behavioral phenomenon, a loss of confidence in a government's ability to service and repay its debt results in a repudiation of the country's bonds and an inflation caused by currency weakness. A confidence crisis like this occurs suddenly rather than in a predictable mechanistic manner. Think tipping points. So if you look at the charts on this page, the upper one tells you what happened to M1 money supply, its rate of increase, after the Great Recession. And you can see that, despite all the QE, which ended in 2014, the increase in money supply was about 7.5%. Not that significant in overall terms. Below, you see the chart that comes from our COVID experience, where we're now seeing an increase in money supply, M1 money supply, of 36, 37% year over year. It's unbelievable what's happening. We haven't seen anything like this since the Second World War, and at least then we had a reason to do it. This is leading to a lot of people suspecting that our dollar can't be counted on. And if you look at the numbers, we got, in terms of Treasury stimulus, 3.1 trillion from Trump, plus another 0.9 trillion during what I call the interregnum before Biden took over. Biden's 1.9 trillion already passed, and now to be followed by US 3 trillion in infrastructure and green investments, except yesterday he said 4 trillion. I don't know if it was a lapse of memory or he's just upped it. So that's 8.9 trillion to 9.9 trillion in addition to regularly scheduled operating deficits, which the US has had since forever. So next slide. The fourth driver, and this is one that involves our foreign friends. Who owns the dollar and how much of it? Foreign investors actually have $25 trillion worth of US securities and cash. If foreign investors no longer want the treasury debt that's denominated in the reserve currency, and they don't, as we'll see, then the Fed is going to have to buy much more, and the dollar is going to go lower. The first chart, US twin deficits, this is always a good leading indicator of where the dollar is going. Of course, you can have little counter trend rallies, but it's going down because the twin deficits are headed much larger. As you can see, been nearly to 27% of GDP. That's unprecedented. Now currently popped up to around 23%. And then to the right, if you look at that chart, the red line tells you where the deficit is headed. So, about 2.4, 2.5 trillion this year. The blue line is the amount of federal debt held by foreigners, international investors. And as you can see, it's evaporating. It's not there anymore. This has a very important effect. Foreign central banks for decades have been sterilizing the US deficit. What does that mean? They bought the bonds, they held that in treasury, in their own central banks, and so it did not manifest in the market. We didn't get an inflationary effect from the deficit, or both deficits. But now they're not holding on to that debt. It's coming back to the market. That's going to overwhelm the Fed in terms of the amount of printing it has to do to support the market. And we won't be seeing any more this process of sterilizing US deficit. Next slide. So what we're predicting is that this is probably the Fed's last rodeo. Not that there won't be a Fed, but it won't have any decision-making power anymore. The Fed is in fact out of options, and it has to hope for transitory inflation, or it is going to be fully exposed. They cannot tighten financial conditions to fight inflation because that will crash markets and the economy. We know that the economy cannot handle even the smallest increase in the Fed funds rate. And also, they cannot allow the long-term rates to continue to escalate, because that too will crash markets and the economy. So they will be left with the only option of suppressing long rates, yield curve control, and that will collapse the dollar, as Louis Gave has said, and I've stated in the past. So get ready for a 20% drop in DXY. Won't happen all at once, but it will happen in an accelerated manner. So just to sum up, on the left, the chart tells you where we have been, which is disinflation. Financial assets have done real well. It's been a happy time for the stock market, and anything real has tended to trade down. But now we're going into what we would call a real bull market for gold, which is the one on the right, the famous one we got in the 70s, because that's what happens to real things when inflation starts to click. With that, David, back to you.
Thank you, Jim. Again, Jim Anthony, co-founder with Rudy of Seabridge, and really appreciate your perspective on things, Jim, as always. So now it's a pleasure to introduce our host today, Rudy Frank. Rudy's the co-founder, chairman, chief executive of Seabridge Gold. He's a veteran in the business. He has over 35 years of experience in the business. He's been involved in every stage of project development. He started Seabridge in 1999. The goal was to successfully create the best leverage play to rising gold prices, which Rudy has done. Seabridge has more gold per common share than any company in the industry. In fact, he also has more copper than most copper companies. Seabridge checks all the boxes: blue chip shareholders, great liquidity on the New York Stock Exchange, plenty of cash in the bank, tight capital structure. They've done the regulatory de-risking, and the management team is a very strong one. So on that note, I'm going to turn the call over to Rudy.
Thanks, David. Thanks, Jim. I need to go out and buy some more gold stocks after that presentation, so thank you. Not that I own enough already. Thanks for the handoff here, David. Yeah, so as David said, we started this company a little more than 21 years ago. We wanted to create what we thought would be the best leverage play to the rising gold price we foresaw, which is obviously happening. And we do that through a very simple concept of trying to grow ounces in the ground faster than shares outstanding. Our belief is that per share metrics are the most important way to drive value by growing your per share metrics. Our industry is the worst allocators of capital on the planet. It's amazing how quickly share counts can go up without offsetting that dilution with real value. And it's not just the junior space. I'll give you an example. Since we formed Seabridge in 1999, the share count of Barrick has gone from 500 million shares to 1.8 billion shares. During that same time, as their share count has more than tripled, the reserves have actually gone down in total, and they're producing about the same amount of gold as they did back then when they had 1/3 the shares outstanding. Newmont, the exact same thing. Their share count has gone from 300 million shares to 800 million shares here recently. The reserves are down during that time, and their production is actually lower. So most companies destroy shareholder value by declining gold ownership per share or production per share or any other share metric you want to see. Our goal has always been to offset dilution with accretion to ounces. Everything we do is focused on growing ounces per share. And as you can see here, over the past 21 years, we've delivered on that. In fact, 2020 was our best year ever in terms of growing ounces per share. we were able to step in and buy a deposit that gives us an additional 35 million ounces of gold. To buy this project, we issued about 6.1 million shares in a bought deal financing. So we got almost 6 ounces of gold per common share. If you look at our per share metrics in terms of reserves or resources, nobody in the industry comes close to us. In fact, we provide 10 to 20 times more gold ownership per share than any other company on the planet. And if you look at what this is translated into in terms of share price performance, it's exactly what Jim and I were hoping for when we formed Seabridge in October of 1999. And that's to deliver exceptional optionality and leverage to the gold price. As you can see here, over the past 2 decades plus, our share price has significantly outperformed, not only against the gold companies, that was easy with the dilution they went through, but also against the gold price itself. The takeaway from this is if you believe that the gold price could go higher or will go higher, and you want exposure to that, Seabridge has a 21-year track record of providing significant leverage and outperformance to gold and other gold equities. The simple fact is if gold is going higher, so will our share price. As David mentioned, we're not just about gold. Along the way, we got very lucky. We found a lot of copper. We talk about our 159 million ounces of gold resources and about 75 million shares outstanding. But in addition to the 159 million ounces of gold resources, we also have over 50 billion pounds of copper, that's with a B, and over 700 million ounces of silver in all resource categories. If you look at our copper metrics on a per share basis compared to the copper industry, we also provide better leverage to the copper price on a per share basis in terms of reserves or resources. And as Jim said, we are very bullish not only on gold, but also on copper going forward. In fact, we're now in the process of putting together our annual report that'll go out to shareholders shortly. That'll focus not only on the gold side, but also drive home the point that we also have tremendous exposure to copper as well. Also, when we formed the company, we also tried to minimize political risk. You can never eliminate political risk in the mining space, but you can minimize it by focusing on jurisdictions where expropriations tend not to happen. So all of our assets are located in Western Canada or the Western United States. Our assets with reserves include KSM and Courageous Lake. And we also, over the past few years, took advantage of a down market again and went out and purchased 3 new earlier stage exploration projects that I'll touch on briefly today. KSM is the project that we have focused most of our resources on now over the past 15 years. It's located in northern British Columbia in what's known as the Golden Triangle. We were one of the first ones into this area by buying this in the year 2000 from Placer Dome. But if you look at how this region has evolved over the past decade plus, a lot of tremendous discoveries, and more recently, a lot of the big companies coming into this district, as evidenced by Imperial Gold now having Newcrest now having a piece of the Red Chris mine with Imperial Gold, Newmont a joint venture with Teck at Galore Creek, and just the other week, Newmont announcing the acquisition of GT Gold for about $450 million in cash. At KSM, we've now spent over $400 million over the past 15 years, defining today not only the world's largest undeveloped gold project as measured by reserves and resources, but also one of the largest undeveloped copper projects in the world as well. We've also successfully taken this project through the environmental assessment process, meaning that we're now shovel ready, permits in hand to start construction. And we also have the support of the local indigenous communities and other communities in and around the project, which is important to us in terms of moving forward with our social license. Another big advantage that we have is tremendous infrastructure that's been put in place with other people's money. When we bought this project from Placer Dome in the year 2000, there were no roads, there was no power, and there were no ports. We now have all 3. Highway 37 just to the east of KSM. Along that highway, the government of Canada has extended the power grid, building a transmission line. The power that goes into that grid is all hydro sourced. We've now secured with BC Hydro through contracts 250 megawatts of power that we'll be able to buy for about 5 cents US per kilowatt hour, some of the cheapest power in the world. And last but not least, just to the south of us, we now have a brand new port facility and an older port facility that's been upgraded. This will allow ourselves and our partner to bring in supplies on a year-round basis and also take concentrate out to anywhere on the Pacific Rim. When we bought this project, only the Kerr and the Sulphurets deposits were known. We found Mitchell in 2006 and we found Iron Cap in 2010. And just recently we purchased Snowfield. If you look at what we now have amassed here in terms of mineral resources, the largest mineral endowment of any single project on the planet. Between these 5 deposits, we have 142 million ounces of gold and over 50 billion pounds of copper. As we went through the environmental assessment process, we are now permitted for a tailings capacity of 2.4 billion tons. But we have 9.8 billion tons of economic resources that have either been constrained by open pit shapes or block cave, underground block cave shapes. So as we look at the best way to attack this project going forward with what we have permitted, we've been working on different mine plans to capture the best economics for the first 2.4 billion tons of material that would be mined. We finished a pre-feasibility study in 2012 that was used as the basis to apply for our permits. We did receive our approvals in late 2014, and in 2016 we updated that pre-feas to take into account commitments we made during the environmental assessment process, as well as changing metal prices and exchange rates. And as you can see here, our base case using metal prices well below where gold and copper are today, and even silver, and also what the project looks like in terms of more reasonable gold prices and copper prices as we now see. This project has over a 50-year mine life, capturing only about 1/4 of the total resources available to us, and can show an all-in cost of production, depending on what metal price you use, somewhere between $400 to $600 an ounce. And that all-in cost of production includes the upfront capital, the sustaining capital, the closure costs, and the operating costs. In addition to the 2016 pre-feas, we then continued exploration activities and found 2 additional zones of much higher grade copper, namely Deep Kerr and Lower Iron Cap. From these 2 deposits, we added nearly 30 billion pounds of copper and over 40 million ounces of gold. We've now done additional mine plans to show what the impact of the project could be as a result of taking into account these higher grade copper zones. In fact, last year we completed a new technical report showing an improvement in the project, being able to show the all-in cost of production going from $670 an ounce at our base case down to about $4 per ounce of gold produced over a 40-year mine life. Tremendous economics, and it's only about to get better. As I mentioned earlier on, in December of last year, we acquired the Snowfield deposit from Pretium Resources. Pretium is right next door to us. They have the Brucejack mine there that is now operating successfully at about 300 some odd thousand ounces of gold production a year. Snowfield sat in their portfolio for a number of years. We actually tried to buy this many times over the years, but only until recently did we get to a point where the deal made sense from both sides. We paid $100 million in cash to buy Snowfield, and they took that $100 million in cash and turned around and paid down debt. Resources at Snowfield total 35 million ounces of gold in an open pit configuration that has a strip ratio of less than 0.5 to 1. In fact, most of the resources, they're already in the measured and indicated category, meaning that an updated pre-feasibility study that's now underway, that we believe a significant portion of those resources can and will go to gold reserves. We are now in the process of collecting the data that's necessary to complete an updated pre-feasibility study, namely around geotechnical information from additional drilling we'll do, as well as additional metallurgical test work, with the expectation that we'll be able to roll out a new pre-feasibility study over the next 12 months or so that'll show even better economics than what we showed, not just in the 2016 pre-feasibility study, but also in what the subsequent studies we did, bringing in the higher grade copper zones. If you look at KSM, it represents an opportunity where whoever the acquirer or the buyer or the partner is on this project, they're going to have different ways to look at this project. The optionality we have here with 5 deposits, each with varying degrees of copper and gold, gives optionality to a copper company that may want to focus on the copper zones first, or a gold company that wants to focus on the open pitable gold reserves. There's nothing out there in the world today that has the flexibility, the optionality, and a project that's already permitted with tremendous economics than what we have at KSM. Our second advanced stage project is Courageous Lake in the Northwest Territories. a project we acquired from Newmont and Total in 2002. We completed a pre-feasibility study in 2012 that at the time showed a marginal project because the Canadian dollar exchange rate was essentially at par with the US dollar rate. However, if you look at this project in the context of a weaker Canadian dollar and stronger gold price, what was marginal back then looks a little different today. Last year, we also did a further study to show that there is a smaller, less capital intensive starter project that you can go after first. We're now deciding what's the best path forward with Courageous Lake. As many of you know that have followed the company over the years, we're not adverse to selling non-core assets at the right time to generate funds that we would then like to spend back into core assets. So we're now working with a banker to see, or is there the possibility to sell Courageous Lake, joint venture it, or perhaps us going back to do more work to drive additional value. So stay tuned there. Where we've had our best success is through the drill bit. We formed Seabridge by finding earlier stage projects that had an exploration upside, then delivered on that through exploration success. We initially bought 15 million ounces of gold in the ground, and through the end of 2020, our gold count went from 100 to 159 million, most of that from the drill bit. As the gold market went down in 2012 to 2015, we started to canvass the portfolios again of the majors and the junior side, and we've now added 3 new projects to the portfolio, any one of which we believe can be a company maker. First one we acquired was the Iskut property by buying a small public company called Snip Gold. We believe that Iskut represents another opportunity like we saw at KSM. It is a gold copper porphyry. It's a large land package. It sits only about 40 kilometers from KSM. On the front end, we got a small resource there that had a little over 2 million ounces of gold and a half a billion pounds of copper. Last year, we started to focus on some of the gold copper porphyry opportunities that exist there. We actually tested one target underneath the old Johnny Mountain mine, and we did come back with intercepts of gold and copper over meaningful widths, not yet into the heart of the system. We will be following up last year's successful drill program with another program this year, hopefully to vector into where the heart of this gold copper porphyry deposit may be situated. Second acquisition was in Nevada, the Snowstorm project that sits on the intersection of the 3 most prolific gold belts in Nevada, the Getchell Trend, the Carlin Trend, and the Northern Nevada Rip Trend. We've been focusing on Getchell style, Turquoise Ridge, Twin Creek style mineralization. Twin Creeks and Turquoise Ridge actually are the 2 big mines that are in the new Nevada joint venture between Newmont and Barrick. We see a lot of similarities at Snowstorm to what we see at Twin Creeks and Turquoise Ridge. In 2019, we confirmed we had the right rocks with the right structures. Last year, we started a drill program that just completed this week, hopefully to vector into where pathways of gold might be to show that there is gold in the system. And we expect to have another drill program later this year, hopefully to vector into where the economic gold grades could be. The best place to find a deposit is right next to an existing mine that's running out of reserves. From the top of our Snowstorm project, you can actually look down the valley and see the huge infrastructure that's in place at Barrick and Newmont's joint venture. Then the most recent acquisition was something we were able to accomplish during the height of COVID, the 3 Aces project in the Yukon, by acquiring 100% of this project from Golden Predator Mining, paying them 300,000 shares to buy it and issuing them a 0.5% royalty. This is not really a project, it's a district, over 300 square kilometers with 35 kilometers of known gold mineralization right at the surface. In fact, if you look at some of the drilling that's been done here by Golden Predator over the years, right at surface, you're finding gold intercepts of multi-meter widths, upwards of 2 to 3 ounces of gold per ton. We'll have our first exploration program at 3 Aces this year. We'll start with geophysics. We believe that there's actually a parallel structure here that we'd like to drill test along with going deeper on what's been drilled here historically. Our geologists believe that this project has 5 to 10 million ounce potential at very, very high grades in an open pit configuration because of how close to surface it is. And we'll start to test that geologic model this year with our first drill program. So looking at why own Seabridge, well, if the price of gold is going up, so will our share price. Just look at our track record for 21 years. We're now sitting with the largest undeveloped gold project in the world, in a world where the major gold companies are running out of reserves. The fact is the gold industry has about 10 years of reserves left. They're depleting their reserves every year, going lower and lower, and not offsetting that with additions from their own exploration. So they're forced to go out and do new projects. We believe that KSM represents the best opportunity out there. Our goal at KSM is to complete a joint venture with a major mining company that has the technical, financial, and social wherewithal to develop this asset. We think there's probably up to 7 companies that meet all those tests that we're looking for. We have turned down proposals in the past from a number of them. We only get to do this once. And I can tell you that the addition of Snowfield, along with copper north of $4 a pound, really strengthens our hands in negotiations. And then, of course, what we're going to be able to show from Snowfield this year in terms of even a better project than we've showed previously in terms of a simpler mine plan. And then last but not least, it's our ability to find gold. We now have 3 new projects, any one of which can be a company maker, and we will be having programs in all 3 of them this year. Finally, if you look at our capital structure, we have about 75 million shares outstanding, market cap today of about 1.2 billion US, 1.6 billion Canadian. One other thing that differentiates ourselves is insider ownership. Insiders of this company, including the likes of Jim Anthony, myself, other co-founders, Albert Friedberg, and officers and directors, hold well more than 30% of the stock of this company. Believe me when I tell you that we think first as shareholders and driving shareholder value than we do about our role as employees and salaries. So David, with that, I'd like to move on to questions, because to me that's the most fun time of these presentations. And as questions come in, don't forget Jim is still on the line, and he'd be happy to take any questions on his comments on the gold market.
Thanks, Rudy. Thanks very much. Great presentation as always. Let's start with Steve Shipman. Stephen, question for Rudy today.
Yes, thank you, David. And thank you again, Rudy. Good to see you. I hope you bear with me on this question because it's not going to be a softball. As you know, I have great respect for you and Jim. When I was at Century Management, I was personally responsible for buying, over 3 million shares at the time. So I have high regard for what you've done and what you can do in locating and spotting opportunities. It's an old saw in my business that it's harder to sell than it is to buy. And so now I witness the great acquisitions that you made and buildup of the KSM project, 5 CAs in hand, and yet you still can't get a deal done on that project. And I'm glad Jim's on the line because he can chip in too, but I'm beginning to believe that it could be your ideology about where the gold price is going is interfering with getting a good deal done. And let me give you one example. Just doing back of the envelope, if you and Jim were willing to strike a deal where all you get is 5% of the gold offtake from KSM at $1,500 gold, that's going to get you $50 million a year pre-tax with no expenses associated with it. And any analyst in the world will tell you you're going to get a 70 multiple on that. That gets you to a $3.5 billion valuation, a $45 per share valuation, plus you have all the rest of your assets to explore. So my question is, what is it that's interfering with you and Jim and the board getting a deal done if it isn't an expectation of an extremely high price of gold that may not be realistic?
Steve, thank you. And you and I have discussed this in the past, and I appreciate your views. And the fact is, if we wanted a deal done like that, we could have had one. It might have solved a short-term upswing in the market for us, but it's not the right deal on the right terms. We didn't spend the last 21 years of building this company the way we did just to give it away and something like that. As I've mentioned, we have turned down proposals in the past from a number of companies. We got close a few times, and then things fell apart for whatever reasons. Our goal in a joint venture is to hang on to at least 30% of this project, while only having to come up with maybe 10% of the capital towards the construction and development of the mine. That's where we're focusing on a joint venture. Deals like this tend to get done when the market is strong. And you have to recognize that, we only finished our first pre-feasibility or got this project permitted in 2014 as the gold market was falling down to about $1,000 an ounce. And it was at a point in time where the large gold companies and the large base metal companies for that matter, because copper also took a hit along with it, were not interested in doing deals. In fact, they were looking to sell non-core assets to pay down the debt and the mistakes that they took on at the previous market top. Timing is important here in terms of getting deals done. Hitting the sweet spot when the majors are willing to do a deal on terms that we can say yes to are far more important to us than doing a quick deal. If we wanted a quick deal, we could have gotten one done. Our goal here is to drive long-term shareholder value. And I can tell you that we have a lot of longer-standing big shareholders that appreciate our patience here and believe that as a result of the patience we show, we will get a much better deal done than perhaps something that you just described there as something that you may drive value on, but it's not the right deal for the company. And let me throw an example out here in terms of what a 30% interest in KSM could mean as we go forward. KSM today, with just our pre-feasibility mine plan, the first 10 years of production will average about $2 billion of cash flow per year. Hanging on to 30% of that project's interest would generate value to us of $600 million a year against the $22 billion, which we would hope to take back in the form of physical gold. Instead of cash flow, we'd rather have gold flow back. That's the kind of deal we're looking for, and that's the kind of deal that we believe we'll be able to get when the market aligns. Unfortunately, the past few years, it just hasn't been amenable to get deals done. If you look at the slowdown in M&A from the last market top to just now starting to pick up, it is changing now, and I think as a result, our stars are now lining up. But if you're looking for a quick deal just for the sake of checking that box, you're owning the wrong company. We're going to get the right deal done with the right partner on the right terms. Jim, anything you want to add to that?
Yeah, I just say that we have never tried to dictate or project a deal based on projections of the gold price or the copper price. We let the prospective joint venture partner tell us what those are. We don't try to impose any kind of view on them. That would be foolish.
Thank you, gentlemen. Appreciate it.
You're welcome.
Let's turn to Jeff Masseri. Jeff's been in this business a long time. He's been in Seabridge. Jeff?
Hi, Rudy. As usual, great presentation. I don't understand how anybody can hear you and not buy the stock. Okay.
I bought some today.
I have a question which we've discussed also many times, which is why, when you purchase a property, do you purchase it in Seabridge? You don't purchase it in another company, which you could then spin off or do whatever you wanted to, or separate out. You buy it in Seabridge itself, making it very hard for you to separate the properties out when the time comes. What is the logic behind that?
Well, Jeff, we don't buy them in Seabridge itself. We actually have a number of subsidiaries set up already, a U.S. subsidiary, a BC subsidiary, Northwest Territories subsidiary. That's where the assets are held. So if an opportunity comes up that we can spin them out in an effective way to our shareholders, we can do that. What I will tell you, though, under Canadian tax code and being a Canadian domiciled company, it's not very effective to spin out companies and create value in that after the spin out, because Revenue Canada will look back 2 years, determine what the upswing was in the value that you may have kept or sold out, and tax you on that number. Right. So it's a great idea. I think when I look at how Seabridge, I believe, is going to unfold over time, I do believe we're going to be successful in getting a joint venture done. I can tell you that right now we're seeing more interest in KSM than at any time in the past 10 years. Once we get that joint venture done on the terms we think we can get that done, we believe that there'll be a whole slew of companies that will want to own what is left of our interest in KSM. And at that point in time, it might make sense to perhaps sell Seabridge as an entity with the bump up in price you'll get from the joint venture. And at the time when you sell Seabridge as the entity, you can then spin out the other assets to your shareholders in some shape or form as Seabridge 2 or even a slew of companies, depending on the best way forward. So that's not something we haven't done it yet, but that could be in our future.
Okay, thank you. And maybe I missed it, but did you talk about how much cash you have on the balance sheet right now?
Yeah, we started the year with about 40 million in the treasury through options and warrants coming in this year. I think there's another 20 million that comes in from that. And then we also, as you know, put the ATM in place, back in place in January, which is a very cost-effective way of raising dollars without much impact in the market at our time and our price. So from a financial perspective, we started this year probably with more cash than we ever have in the 21 years I've run the company.
Okay, thank you very much, Rudy. Keep doing what you're doing.
Thank you, Jeffrey, as always. So we'll turn to Howie Flinker. Howie, do you have a question today for Rudy?
Yeah, I had to unmute myself. Hi, Rudy.
Hi, Howie.
Could you develop Courageous Lake separately?
Yeah, you could. I mean, yes, you can. I mean, it's probably another, the permitting in North America or anywhere in the world today is as challenging as I've ever seen it in my 40 years in the business. So probably to get Courageous Lake permitted, it's probably 4 to 5 years, even on the smaller startup scale that we've talked about. So, from our perspective, it's not a very cost-effective way to use shareholder funds. But, as we discuss potential joint ventures on Courageous Lake with partners, perhaps having the partner come in and spend the dollars to get it fully permitted and constructed might be the best way to go. As you know, Harry, we're not builders of mines. One of our guiding principles is we will never build a mine for our own account, but at the right time, partner or sell projects with companies that can do it justice. And hopefully, if we do sell a project, keep residual interest in that project.
Okay, I'll see you in Colorado. I think this year physically.
I'm going to be there as well.
Yeah, good. Okay, stay healthy.
Will do.
Thanks, Howie. We'll turn to Chesley Morton. Chesley, question today.
There we go.
Yeah.
Okay. First of all, I want to echo the other sentiment mentioned that it was a great presentation, always good, and it seems to get better along with your resources. So I'm thinking about the retail investor who might be listening to this presentation who can't really dive into a lot of the technical aspects of it, but needs some sort of touchstone to kind of figure out when your stars come into alignment, as you mentioned earlier. And would you suppose that might be closer to happening around 2200 gold?
Yeah, obviously higher metal prices definitely strengthens our hands in negotiations. There's no doubt about that. But even when you talk, let's say copper at $4 a pound today, I can tell you firsthand that even though the big copper companies believe it's going to go higher, when they do their valuations that they need to project to the boards for deal approvals, they're using a much lower copper price in their analysis. Same thing with gold companies and the gold price. Even Barrick today talks about a project needing to be economic at $1,200 gold and at $1,500 gold being able to show an IRR, after-tax IRR, better than 15%. So we all like higher prices, but we also have to protect to make sure that if we are going to invest in a project, that it actually has a chance at a lower metal price environment as well.
It's been my observation that the majors always seem to do the deals at the top of the market. And it's not panic buying, but it almost feels like that sometimes when suddenly that rational approach that you just mentioned seems to take a back seat to gathering assets. If we should move into the $2,200 range and stay there, wouldn't you guess there'd be a lot of M&A out there?
Oh, absolutely. And I've been in the business 40 years now. I've seen a number of market tops where the companies do the stupidest deals at the top of the market. And then as the market goes against them, which invariably it does, they're forced to sell non-core assets. I think one of the reasons that happens is that market tops, they tend to have a different shareholder base than they do at market bottoms.
Right.
At market tops, they have people that, that believe that the prices are still going to go a lot higher and they want to see growth, so they go out and force them to do deals. At market bottoms, it's a different set of shareholders. Those guys are all flushed out at the top on the way down, and it's a new set of shareholders that come in and want to conserve cash, build cash flow, and get rid of non-producing assets or assets that may not make it in a much lower gold price environment. We don't make the rules. We just enjoy the tops when they come along, and we'll take advantage of that, when that happens again. And I have no doubt in my mind that we're now starting to see a pickup in M&A because of that fact.
I'm glad that Seabridge has a steady hand on the tiller. Thank you.
You're welcome.
Thank you, Chesley. We're going to turn to Paul Forsyth. Paul, we'll unmute you there.
Hi.
There you are, Paul. We can indeed, Paul.
Okay. First of all, thanks again for, I've known you for 15 years or so, and every time I hear your presentation, I kind of like Steve, your first speaker, and he was, the frustration that we have. Wonder why in the hell he tells such a great story. What the hell is keeping anybody from behind this? Obviously, you say you've had some offers, but what is the impediment of why they're not, hitting the bid? And then another question would be, what are the Chinese doing? I mean, this has got to be very located. This would have to be a real plum. So, anyways.
Well, Paul, thanks for the question and good hearing from you. I mean, up until recently, the market conditions were still tough. The majors were still focusing on selling non-core assets and paying down debt. They weren't doing deals. That was just a fact. What I will tell you, in the absence of COVID, I'm pretty confident a deal would have been done by now. We actually were working with a syndicate that had promised us a proposal sometime in April of last year. And then when COVID hit, obviously everything shut down on the M&A side, which is not surprising. But now that the world is opening up again with copper at $4 a pound, I'm glad we didn't get the deal done last year, because I think we're going to be able to do a better one now as a result of where we stand, not only with metal prices, but also with the addition of Snowfield. So, yeah, I mean, look, nobody wants to do a deal more than I do. Believe me when I say that. I've got 95% of my family's net worth tied up in Seabridge common shares. A deal will unlock value right away. I have probably the best incentive on the work of anyone out there to get a deal done, but it's got to be the right deal on the right terms, and we're not going to waver from that. In fact, our shareholders are counting on us doing the right deal at the right time, not just a quick deal for getting one done.
I can attribute, Rudy, you've never wavered. A lot of these questions come up, but you know exactly where you're headed. Let's talk. I'm sorry.
Can you follow up on the China question? This has to be very appealing to China for a Chinese company, would it not?
Yeah, Paul, social license is important. We built up a tremendous reputation with the regulators and the First Nation. Our view is that a Chinese company as an operator of KSM makes no sense whatsoever. We will lose whatever social graces we've earned there over the years by bringing a Chinese operator in. So our focus has been on the better known North American listed companies that build projects correctly and safely.
Thanks.
You're welcome.
Okay, let's turn to Murray Vanderbilt. Murray, we've got Murray on the line with us. Always good to have Murray.
Hi, Rudy. Good to talk to you again. I have two questions, basically. Uh, I've come to learn that it's grade or price that I think is also an obstacle here. So outside of waving a magic wand and upgrading the grade a little bit, the other is price, which we've already discussed. But it occurs to me, so Barrick and Newmont work together in Nevada.
Yep.
And I understand that works reasonably well. And given the size of this project, ultimately, when you're having these discussions, you mentioned syndicate earlier. Is there any chance that two of these guys will get together?
Yeah, I think that is likely. I think it's more likely to be a copper company with perhaps a gold company and or a smelter company. You know, you look at the scale of this project. I mean, we're now looking at design throughputs of 190,000 tons a day through the mill. That's bigger than any mine that Barrick or Newmont has ever built. And it still takes us, 40 years to get through a quarter of the resources we have at that throughput rate. My view has always been that this project is probably more attuned to a big base metal company in terms of they built mines like this, they operate mines like this, and a $5 billion upfront capital is something that they deal with all the time. But I do believe that there could be a syndicate play here with a gold company and a copper company together, but probably more realistically with a copper company and a financial partner as a smelting company that wants the offtake on the copper and is willing to provide pre-production financing against that eventual offtake. So, but yeah, I think that's likely. What I will say, I can tell you firsthand that the only reason that the Newmont joint venture, Barrick joint venture is working is because Barrick controls everything. Newmont is, I'll be careful. I won't be careful. I can speak my mind. Newmont kind of got taken, it got played last year on that deal when Newmont was so worried about the hostile deal that Barrick put forward. And in my view, what Barrick was looking for was just to get a joint venture done. And that's what they get done on terms that from the outside looking in was very weighed towards the Barrick side.
Interesting. Okay, last question. You're talking about doing a feasibility study on Snowfield. Do the majors want that now, or is that just to, boost the numbers for the investment public? I mean, I think the money might be better spent doing more work in the Klondike or down at Snowfield or something, or Iskut, and advancing those properties.
Well, I'm glad you asked that question because I forgot to mention that we're not doing just a pre-feas on Snowfield. We're doing a new pre-feas on KSM. The great thing about the addition of Snowfield is that all the infrastructure that's already designed and permitted at KSM works with Snowfield coming into that mine plan. The pre-feas will just put forward a new mine plan that'll take some tons out of our existing mine plans and replacing it with easier mined and higher grade gold from the Snowfield deposit. So it's not a lot of dollars that are being spent on this, but what we think it will show is a significant improvement to the project's IRR, net present value, and payback period. And that's definitely worth doing.
Have the majors asked for that, or they say, sounds pretty good, why don't you run these numbers for us and show them to us? Or
well, they run the numbers on their own. They have the same data, as they sign a CA,
Okay.
they have the same data that we have.
Well, where I was going with that, I'd love to see some progress on these other outlying properties, because I think there's some really nice potential there, and it'd be interesting to see that come in.
Well, we have meaningful programs planned at Snowstorm, Iskut, and Three Aces this year. So we will be spending dollars on those other projects.
Okay, great. Thanks for the update as usual.
Thanks, Murray.
Thank you, Murray. We'll turn to Nick Polidris. Nick? He's unmuted. Nick? Just give me a second, please. Thanks for your patience. Scott? It doesn't seem to.
Yeah, I sent an unmute request to Nick. Maybe he is having an issue.
Let's turn to Nicholas Riccardi.
also sent. Nicholas, if you can unmute yourself by using the microphone icon.
And we'll go to Doug Loud because Doug's ready for a question.
Also, we do have Marshall Barrel as well.
Okay, we'll go to Marshall after Doug. Hi, Doug.
Hey there. Hi, Rudy. The problem
Doug.
with this presentation is that it's wonderful, but it's after the market is closed, so you can't go buy more stock when this price is down. So I'll have to wait till tomorrow. I heard everything you said, and I just want to confirm it in my tiny, easily confused lawyer's mind, which is you have your permits, you have your stuff set to go. If you got your joint venture signed tomorrow, they could start tomorrow?
Oh, that's correct. Yeah, and what they would start is with site capture. You know, getting road access into the project early on will definitely help the timeline to construction. So recognize that you still have to complete a bankable feasibility before the real big dollars will be spent. And that's something that, you know, we are collecting data that would be necessary for that each and every year. So we make it more quicker for a partner to complete that bankable feasibility. But, you know, as we went through the environmental assessment process, we did not just get our environmental certificate. We also got the first 55 permits in hand that basically cover the first 2 to 2.5 years of construction of a 5-year build out. So, yeah, depending on our partner's appetite, how quick do they want to get this to production? This project is shovel ready.
That's just great. Thank you so much for everything you do.
Welcome, Doug.
Scott, Nick Polidoris is unmuted, so we'll turn to you. Nick, question today?
Okay, can you hear me?
We can hear you
Yes.
fine, Nick.
Okay, great. Excellent presentation. And my question you just answered is how long would it take? And you make it sound like about 5 years to get this into production. Am I correct?
That is correct.
Okay, that was it. Thank you.
We'll turn to Marshall Barrel.
Hi, thank you very much. Hi, Rudy and Jim. A usual excellent presentation to both of you. I've got one comment and a couple of questions. The comment is, I'm glad to hear you say, Rudy, that the annual report is going to put some more emphasis on copper, because I think with copper at $4 and gold at 17 and not doing all that well, that the investing public doesn't fully recognize and appreciate that you've got a very, very, very significant copper project there along with gold, and that certainly may help the market's understanding of the KSM project to put more emphasis on copper. My question, one for each of you. Jim, you mentioned looking out and seeing $2,300 gold out there. What kind of time frame do you think for that with your premise about inflation and the Fed and all?
I think that unfolds quickly once inflation has been demonstrated and the Fed's entire monetary policy has been upended. I think it brings a lot of money into the sector, and it certainly depresses the dollar in a big way. So, you know, what I think we see right now in the gold market is something that's pretty tightly wound as a spring. We've had sentiment indicators get as low as they would ever need to go for a very significant rally. Right now, all the hot money, the new money, is headed toward a 6% plus growth story in the US economy and therefore the stock market. But I don't think that stays as soon as you start to see the inflation number kick in. And what does that take? Well, it might be as little as a 2% yield on the 10-year Treasury. And right now, as of this morning, actually, we were at 1.77, and that's from 0.6 6 months ago. So things are moving out of control pretty quickly. I can see that over the next 3 to 4 months, we're going to see the Fed have to change its policy and go to yield control. And then I think you see $2,300 gold within 6 months. That's our view.
That's very interesting. And Rudy, you mentioned you're working on an updated PFS, which, as I understand it, is the entire KSM project, including Snowfield, What's your anticipated timing on having that available?
Well, you know, unfortunately, when you do a PFS, we probably have 30 outside technical experts working on it. So it's hard for me to keep them geared to the clock. But our expectation is we should have that done in about a year, Marshall, if all things go according to plan. What we need to do first, though, is collect additional data in the field. We do need to take some drill samples from Snowfield and Mitchell again. We want to run some more metallurgical tests. We did a bunch of that in the year 2010. We want to update that metallurgy to show, you know, how we may need to tweak the mill based on how those two ores blend together. And then we also need to do some geotechnical drilling just to confirm the pit slopes that we can drive at Snowfield. So there is data collection that has to happen first, and then moving on to the engineering after that. So what my team tells me is that expect to have it done by the end of Q1 of 2022. If they get it done quicker, that's great.
Sure. And then in the meantime, I assume there'll be some drill results out from your other 3 projects that you're working on, actively working on?
Correct. As a matter of fact, I think I mentioned we just finished up last year's drill program at Snowstorm in Nevada, got off to a slow start. We actually just finished that program, and we expect to announce the results of that over the next few weeks. And then we'll get back into new programs at Snowstorm again, at Iskut, and at 3 Aces.
Okay, great. Well, gentlemen, thank you for the updates. Thank you for the information. And Rudy, as you know, some of us are sticking with you. Have been around a long time, and are looking for that finish line announcement coming out, or not finish line, but the next major step announcement coming out. Thank you.
Thanks, Marshall. It has been 20 years since you and I have met and kept in touch. And it's remarkable that you were the last person I met face to face when COVID shut us down last March.
Absolutely. I mentioned that to somebody just the other day. I said, you know, it was a year since my last business meeting, and it happened to be with Rudy Frank of Seabridge.
Fair enough. Thanks.
Thank you, Marshall, for your questions. Rudy, that concludes the questions, so I'm going to turn it back to you for closing remarks, please.
Okay. Well, again, we appreciate the opportunity of presenting to you here today. You know, last year was a tough year with COVID, but when we look back on the year in terms of what we accomplished in spite of COVID, as well as doing that acquisition at the end of the year, I believe that the acquisition of Snowfield is the most transformative and a creative acquisition we've ever done at Seabridge. And I think over time that will not just, you know, bear out in our share price, but also in our ability to get a deal done. So look forward to our next time together. In the meantime, don't hesitate to reach out with follow-up questions. You can either go through O&M Partners, or you can email me directly. My email is Rudy, R-U-D-I, @SeabridgeGold.com. So thank you, everybody, and enjoy the rest of the day.
Thanks, everyone, for your presence today, and I wish you a very pleasant evening.